Hello, I'm David Cassidy with the market update. Today, Tuesday, the 23rd of June. Although the FTSE 100 index ended yesterday slightly lower due to concerns that the coronavirus infection rates are still rising, especially in the US, interestingly, US markets weren't particularly concerned and indeed ended the day higher as economic data continues to point to a V-shaped economic recovery. The Chicago Fed National Activity Index came in much better than expected at plus 2.6 versus consensus estimates of minus 10, which is consistent with last week's strong readings from the Empire State and the Philadelphia Fed surveys. Additionally, Sherwin-Williams, a US paint manufacturer and retailer, said that while its second quarter sales will be lower than the same period in 2019, the decline won't be as bad as they originally forecasted back in April, as people stuck at home have started to do more home improvements. Now, this is consistent with recent statements from Home Depot, or Depot as they say in America, and Lowe's, two US DIY retailers similar to B&Q here in the UK. And as with the UK, US housing is important as it has a profound effect on the wider economy, as it can improve confidence, encourage consumer spending, contribute to economic output, create jobs, for example. Now, although the UK is behind the reopening curve, this morning's PMI, Purchasing Managers Index, also provided evidence of an economic recovery as the readings rocketed higher. The composite reading had its biggest monthly gain since the survey began in 1998, climbing to 47.6 from 30 in May. Although that is still below 50, and 50 is the line separating expansion and contraction, so reading below 50 signals the UK economy is contracting, the manufacturing index climbed to 50.1 from 40.7. In other words, expansion. The services activity measure also rose to 47 from 29. All this data suggests to us that not only have we passed the low point as the global economy appears to have bottomed during April and May, but we've already are starting to rebound strongly, hence why we have continuously argued that it was best to focus on the likely duration of the economic decline rather than the depth. As such, this is positive for company profits, and not only does this mean that equity markets are on a solid footing, but provides a compelling case that the equity market rally can continue.